welcome to the Capital Stewards podcast. My name is Brian C., and today we are diving deep into one of the most important and often misunderstood pillars of retirement planning, and that is Social Security. Whether you're a few years from retirement or you're already mapping out what your retirement income picture is going to look like over the next couple of years, understanding how Social Security works and how to optimize it can make a six-figure difference over your lifetime. So we're going to cover everything from when to claim Social Security to spousal benefits to tax implications. So let's dive in. So let's start with the fundamentals. Social Security isn't just a government check. It's a structured pension program based on your lifetime earnings, your age, when you claim, and your marital status. All right, so how does it work? Each time you get a paycheck, you have a section of taxes known as OASDI, Old Age Survivors and Disability Insurance Taxes. It's a mouthful. As an employee, if you work at a company, you pay 6.2% of your earnings into OASDI, and your employer pays another 6.2% of your earnings on earnings up to the maximum, which changes, but right now it's $176,000. And that money goes into this pension program. If you're self-employed or if you own a business, you pay the full 12.4%, but don't worry, you get a special tax credit to help reduce what would have been the employer's part of those taxes. So every time you get a paycheck, you pay into the program. The money goes to the federal government. There is a Social Security trust fund, but the U.S. government does not segregate off Social Security contributions or benefit payments like an ordinary company would. Your paycheck taxes just go into the general fund, and your benefit payments just come out of the interest on the Social Security trust fund plus the government's general fund. I did an entire episode on the inner workings of Social Security last summer, its longevity, whether or not it's going to go bankrupt or not. So I'm not going to go into a ton of detail on that again here. You can go back to, I think it was last June of 2024, and listen to that whole episode if you want. The most important thing for you to know when you're planning for retirement, though, is that benefits are unlikely to change for those that receive them today, or they're going to receive them in the near future, in the next couple of years. However, that Social Security trust fund will be exhausted sometime in the mid-2030s if we don't make changes to the program. No politics, that's just what the math says. So if you're planning to begin receiving Social Security payments after around 2035, I would expect that there are going to be some changes that are made between now and then. You might have to wait longer to receive your benefits, something like that, than today's beneficiaries. So perhaps the full retirement age creeps up a little bit, maybe benefits go down in some of those out years. So probably changes coming in the mid-2030s, but not anything short-term today. It's also worth remembering that Social Security also covers disability and survivor's benefits for families that lose a working parent or a spouse. Again, I'm not going to spend a ton of time on this today, but it's a very important part of the program. So if you are a widow, or if if you're a minor, right? Probably not listed as if you're a minor, but for people that have children that maybe a spouse has passed away or something like that, there are Social Security benefits that you can claim as well. But today we're going to focus mostly on the retirement planning portion, because that's what most folks use Social Security for. So how do they calculate those retirement benefits with all that money that you've paid into the trust fund? Social Security is calculated using your highest 35 earning years. If you retire early and you don't work for 35 years, those missing years are filled in with zeros, dragging down your average indexed monthly earnings, or the AIME. I won't go into the full complexities of the pension calculation, but it's available on the Social Security website. And if you know what your gross earnings are for each year, you should be able to accurately calculate your own Social Security benefit. Thankfully, the SSA, or the Social Security Administration, tracks this information for us. And so you can log in and view your projected benefits. One thing about those projected benefits, though, and I talked about this a second ago with like early retirement, what they're doing is projecting what your benefit will be if you retire at full retirement age, based on your earnings sort of continuing on the same trajectory that they've been historically. So if you retire early, you're not going to get what that projected benefit number says that you're going to get. That's not what's accrued today. That's what they expect to get in the future. So just kind of keep that in mind when you're looking up your benefits. And speaking of which, it's probably a good time to pause before we dive into some of the details of claiming Social Security, and just kind of do a PSA, a public announcement here, that it would be a good idea for you to go create a Social Security account, even if you're younger, on the SSA.gov website. You can go there, create an account, and you can look at what your benefits are and make sure they've got all the right information in there from your prior earnings history. So you can do that. You don't need any sort of special access. You can go look that up yourself. So what are the key thresholds for claiming benefits when you get ready for doing that in retirement? The earliest claiming age is 62. right? That's the first time you can have access to those benefits. And we'll talk more about whether that's a good idea or not in a minute. Full retirement age is, for most folks now, is 67. It might be slightly earlier than that if you were born before 1959, but for most folks, it's age 67. And then the maximum benefit age is age 70. If you claim at 62, that gives you early access to your benefits, but it reduces that monthly amount by up to 30%. If you wait till full retirement age, till 67, you get your full retirement benefit. And then if you delay it till 70, a common strategy, we'll talk more about that in a minute, that can boost your retirement payout by up to 32%. So thanks to those sort of delayed retirement credits that you get in the program. So when you claim is an important part of the strategy, and we'll talk more about some of those different claiming strategies in a few minutes. Let's talk about couples. Obviously, one of the most common scenarios that we see in our practice, and one of the most common scenarios that are out there, especially when you have one spouse that worked and another spouse that either didn't work or earned significantly less over the course of their working career. The non-working spouse can still receive benefits based on the working spouse's record. So here's how that works. You have to be married for at least a year. So currently married. We'll talk about divorce situations a little bit further down, but you have to be married for at least a year. The working spouse has to be receiving benefits, so that you can't apply for your spousal benefit before your spouse starts receiving theirs. So that was a change back in 2015 and 2016. So it's important that you know that. You may have heard that folks did that in the past. Your spouse has to be receiving their benefits for you to get yours. The non-working spouse has to be 62. That makes sense. And then the maximum spousal benefit is 50% of the working spouse's full retirement benefit. And the timing there matters, because if the non-working spouse claims before the full retirement age, before 67, their benefit is reduced potentially just to a third, or 32.5% of the working spouse's benefit. And that's because the government doesn't just reduce the benefit level like they are for the working spouse. They're adjusting the percentage of that benefit that you're eligible for. So let's walk through a scenario there. Let's say John was born in 1959. He has a full retirement benefit of $2,400 a month. His wife, Mary, born in 1960, never worked. If Mary claims at 62, she'll get about $800 a month. If she waits until full retirement age, she'll get $1,200 a month. So you can see there's a big difference between age 62 to age 67 for non-working spouses. The same is not true, however, for non-working spouses that wait from age 67 to 70. Your spousal benefit doesn't get those extra retirement credits between age 67 and 70. So that means the working spouse might wait till age 70 to maximize benefits. The non-working spouse's benefits stop getting larger at age 67 or full retirement age. So which non-working spouse claim? Ideally at full retirement age. That's because that's when those benefits have kind of maxed out and don't increase past that. Claiming early reduces your benefits, obviously, and delaying past full retirement age doesn't help. And we'll talk about early claiming strategies in a few minutes. In some cases, it might make sense if you have a spouse who was working and has their own benefits. Perhaps they claim early and use some of their own benefits before they attach to their spousal benefits at age 70. So there are some opportunities there. If you are working and you have your own benefits, you're not completely relying on the working spouse's history to maybe apply before that age 70 threshold. So we'll talk about that more in a minute. I think it's helpful before we move into some more detailed discussion around claiming strategies. Let's talk a little bit about some potential scenarios. I think put some numbers behind this stuff makes it easier to understand. So scenario one, we've got John, we've got Mary again. John, if they claim at age 62, he's going to get $1,680 a month. Mary is his non-working spouse. She's going to get $800 a month, total $2,400 a month. So the pros of doing that at age 62, they get income immediately, right? The challenge, though, is there's a permanent reduction in what they're going to get from Social Security. It's never going to go, obviously, be adjusted for inflation, but the benefit level is never going to go up. And there's also a lower survivor benefit for Mary, right? When John passes away, that survivor benefit also is locked in when you claim at 62, so that benefit goes down as well. So scenario two, John delays until age 70. That's when his Social Security is maximized. And then Mary claims at full retirement age. So John gets $3,000 a month. Mary gets $1,200 a month. That's a total of $4,200 a month. So a lot of extra money every single month by waiting a few years to claim. Obviously, higher lifetime payout there, stronger survivor benefit, but you have to have other income to get you all the way to age 70. And then there's kind of splitting the difference, right? You both claim at the full retirement age. John's gets $2,400 a month. Mary gets $1,200 a month, or 50% of John's. Total is $3,600 a month. balanced approach. They miss out on the extra credits that they could have gotten, but they have that income a little bit earlier. So each scenario has trade-offs, and the right choice is going to depend on your health, your income needs, long-term goals, all those sorts of things. For most people, so let's talk about some strategies here. For most people, waiting until full retirement age or age 70 is going to maximize your Social Security benefits. So, but you do need to believe that you're going to live long enough to break even on that time period that you waited. So let's talk about this break even analysis for a minute. This is the point where waiting to claim results in more total lifetime benefits than if you had just, started getting the money early, right? So if I start getting money at 62, then I die at 65, it's a good thing I started claiming 62, right? Because I get all that money, right? So let's talk through kind of a simplified example here. So if I claim at 62 and I get $1,680 a month, I can claim at 67, get $2,400 a month, or I can wait till age 70 and get $3,000 a month. If you claim at 62, you get those smaller checks earlier. If you wait until 70, you get larger checks, but you get fewer of them. And so what's important to understand here is what's the break-even age, right? What's that break-even point where those bigger checks mean I've gotten more money from Social Security than I would have otherwise gotten had I started to claim early. And the break-even point between claiming at 62 and 70 is generally around 80 to 82 years old. So basically 10 years. If you live past that, delaying pays off. And a lot of folks today in the modern world, they do live longer than age 80 or 82. So that's why we see a lot of folks wait. So many folks will wait to claim until 67 for retirement age or age 70, but there are some scenarios where it might make sense to claim early. So when does it actually make sense to claim early? Number one, obviously, if you have a shorter life expectancy, if you don't expect to live past your late 70s, maybe you've got some underlying health issues, something like that, it might make sense to start claiming your benefits sooner. If you have an immediate income need, if you retire early and you need income, then Social Security can help bridge that gap. If you have a low earnings history, if your benefits only modest to start with, then delaying may not actually help that much, right? So it might mean that break-even period is actually longer. You may be better off just go ahead and taking your benefits. And then coordination between spouses, right? So if you've got two working spouses together, the lower income earner might claim earlier, maybe the higher income earner delays, and then you sort of switch over to that spousal benefit and you balance cash flow and survivor protection. So, and the last reason for claiming early, maybe there's market volatility. This is not like, hey, the market's down 5%, but if there was a really significant market event, like a great financial crisis again, or something like that, there could be some scenarios where you say, hey, instead of selling some assets that are going to rebound, I'm going to take Social Security payments in lieu of that. So there are some reasons why claiming early can work. It's just not the most common scenario that does work, but you got to do the math on your own situation and understand what makes the most sense for you. Now, let's talk taxes. Yes, Social Security is still taxed. In the One Big Beautiful Bill Act from this past summer, you may have heard that Social Security is now tax-free. That is not the case. What the bill really did was to increase the standard deduction for everybody over age 65, which has the impact of offsetting all or most of the taxes that come on Social Security income. But you get the standard deduction regardless of whether you do smart tax planning or not. And since the taxation rules around Social Security itself have not changed, it pays to be smart about your Social Security strategy. So in 2025, the IRS used combined income to determine how much of your benefits are taxable. So combined income, this has been the way it's worked for a long time. That's your adjusted gross income, or the amount of income that you earn that you pay taxes on. And then they add back to that non-taxable interest. The most common source of that is municipal bonds. So if you have muni bonds that aren't paying federal taxes on, still a good idea to own those things, but that interest is going to get added back to this payment. And then they also add half of your Social Security benefits to that number to create your combined income. And then they have these thresholds. So if that combined income total is less than $32,000, benefits are tax-free. You still get the higher standard deduction. If your combined income is between $32,000 and $44,000, then half of your Social Security is taxed. And then above $44,000, up to 85% of your Social Security is taxed. That's the scenario that most of our listeners, clients are kind of find themselves in. And then of course there's that new twist that I mentioned. Now, starting for this tax year, couples that are age 65 plus can claim a standard deduction of $46,700. That's higher than the $33,200 that most folks, at least married filing jointly folks, will get. And so that additional standard deduction can help offset Social Security taxes. So let's talk about strategies to minimize taxes on Social Security. So one of those, and this is just generally how to minimize taxes in retirement, but obviously it applies to minimizing taxes on Social Security as well, is to use Roth accounts. If we're saving into a Roth or we do Roth conversions early in retirement before Social Security kicks in, then perhaps we've got tax-free income, right, that won't show up in that AGI number that we can use to fund our retirement income, and that might reduce the amount of our Social Security that becomes taxable. So that's probably the number one strategy that I think that we employ with clients that I see is effective in helping mitigate retirement taxes in general and taxes on Social Security. You can delay claiming, obviously, and this kind of goes with number one, right? But if you're trying to tax manage your situation through retirement, delaying claiming Social Security oftentimes give you these years at the very beginning of retirement where your employment income has stopped. You've just got the earnings that are coming out of your investment accounts. And if you can afford to do that, then you can use those years to do some Roth conversions and other things where your taxable income is a lot lower, and that pays off oftentimes in spades down the road. So use Roths and delay claiming until later, and that gives you the opportunity to do some things like Roth conversions early in retirement. You want to sequence your withdrawals out of your retirement accounts. There is no one-size-fits-all approach to which retirement account you should withdraw from first in retirement. The best structure is to use a flexible approach. In years where you have higher taxable income from pensions or other retirement assets, you may want to use your taxable account or your Roth for additional retirement withdrawals. In years where your retirement income is lower, then you want to use your IRA or your 401k. That might be the best option. Building the right sequence for your situation requires planning well in advance of retirement so that you can accumulate money inside the right accounts. You're going to get the money in those accounts so that we then have the opportunity to use them in retirement in intelligent ways. You want to manage your RMDs, right? Required minimum distributions. They start at age 73. And once they start, it's really hard to do a whole lot about them. That's why planning before retirement and in early retirement is really critical. Once RMDs start, you can do qualified charitable distributions and other things. Those are charitable contributions that come directly from your IRA to try to offset some of that income, maybe to get your taxes, down below that 85% threshold on Social Security. But it's hard to do that. And then, so those are, I think, some good strategies to help mitigate taxes on just in retirement in general, but also on Social Security. Let's talk about non-working spouses. Can the non-working spouse claim retirement benefits first? We talked about that. I kind of hinted at it a few minutes ago. The non-working spouse usually can't claim their benefits until the working spouse has claimed their benefit. There's a couple of exceptions to that. So one is if there's a situation where someone's passed away, or if they're caring for a child that's under 16, maybe there's an adoption, something's happened in your family, then you might be able to get those benefits early. And the other scenario there that could work is if you were working, say you've got a husband and a wife, and the wife makes more money than the husband in this scenario for over a long period of time. But if the husband's working, he's got his own Social Security benefit. So there could be a scenario where he claims his own benefit starting at 62 or 65 or 67, and then switches over to a higher spousal benefit at age 70 when the higher income earning wife claims her benefit. So there are scenarios where you might claim your own benefit, but you're not claiming the spousal benefit before the person who, the spouse, the higher income earner, is claiming their benefit. And then lastly, divorced spouses. So if you are divorced previously, if you were married for 10 years or more and you're currently not married, then you can claim spousal benefits at 62, or 60 or 67 or 70 if your ex-spouse has not filed yet. You don't need them to file in order to claim your spousal benefits in that case. So if you have been divorced, remember that the rules there, you got to be married for 10 plus years to start with, and you can't get remarried. That's really important. You got to understand that when you get remarried, your spousal benefit then switches over to your current spouse. So it's important to kind of think about that as you are planning for retirement. Let's talk about maxing out your benefit. Some folks say, hey, I want to try to max out my Social Security benefit. What is the largest Social Security payment that you can get? In 2025, the maximum contribution that you can make to Social Security is that 12.5% times $176,100. So when your earnings go over $176,000, you stop paying Social Security taxes on earnings above that. So that means effectively once you pay $10,900 into Social Security, they stop taking more money out of your paycheck. You've contributed the maximum amount possible. You'll get the maximum benefit credit for the current year. But to max out Social Security, you have to max out that threshold every single year, and you have to do it over 35 years in order to get the maximum benefit. So that means for most folks, if you're thinking about full retirement age, you basically started making more than $176,000 or the inflation equivalent adjusted amount when you were 32 years old. So there are folks that this applies to, especially in today's world, in a community of high earners, lots of engineers, pilots, things like that. So you got to be making that amount for a pretty long period of time. You also, key kicker here, you have to claim when you're 70, not when you're 67. You need all those maximum benefit credits. The maximum benefit is $61,296 a year. That's $5,100 a month, roughly. If you claim earlier, that benefit goes down to $48,000 at 67, or $33,000 if you claim at age 62. So there's a $27,000 difference if you're a maximum Social Security recipient between claiming at 62 and age 70. So keep that in mind. If you want to truly maximize your Social Security benefits and you contribute the most, the way to do that is to wait until age 70 to claim those benefits. Let's talk a little bit about working while getting Social Security benefits. So what if you're still working and you want to claim Social Security? I get this question a lot, as a lot of folks are working into their 60s, even if it's a part-time job or something like in a nonprofit setting where maybe they've taken a step back career-wise. They're not really working the hours and the pressure that they were working in their sort of primary career, but they're still earning a little bit of money. In 2025, if you're under 67 or under that full retirement age and you earn more than $23,400, Social Security will withhold $1 for every $2 you earn over that limit. So they're going to reduce the amount of benefit payments that you get. But don't worry, it's not lost forever. Once you get full retirement age, once you get to 67, then they'll recalculate your benefit and they'll add money to future payments to make up for that. So let's talk about an example here. It's kind of complicated. So say you're 63 and you take a job teaching and that pays $33,400 each year. Let's assume your prior monthly benefit was $4,000 or $48,000 for the year. The earnings limit that I mentioned was $23,400. So you make $33,400, you're $10,000 over the earnings limit. That means Social Security is going to reduce your current benefits by $5,000 or half of that amount. And so your current benefits go down to $3,500 a month or $43,000 for the year. So most folks don't work and claim Social Security, but there are some scenarios, even if it's personal choice, where I just say, hey, I really like what I do and I want to keep doing this and I'm going to keep earning money. That's what happens when you do that. And it applies between 62 and 67. So once you hit 67, there's no earnings limit. You can work as much as you want, earn as much as you want. You're getting your full Social Security check regardless. So that benefit recalculation thing happens between age 62 and age 67. So their intention there is to make it easier for people to phase into retirement, maybe work part-time, those kinds of things. In practice, what I find is a lot of folks don't, they're trying to delay Social Security, so they take a part-time job as opposed to, both working and getting Social Security. But it potentially could be a strategy for some folks that are out there. So, all right, we've talked about a lot of stuff. What are the things you need to know? What are the things you need to take away from this conversation? So first thing is you need to know your full retirement age. For most folks, that's 67. If you were born in the 50s, could be a little bit earlier. You want to review your earnings history. Like I said, go online, create an account. Obviously, aim for a full 35 years to avoid zeros in your calculation and get as much money in there as you can. Remember that Social Security is one part of your retirement income. Simply maximizing your Social Security payout might have negative tax implications that make you worse off. So it's really important to take your entire financial picture into account when you make those Social Security claiming decisions. Don't just say, hey, well, I want to maximize Social Security. There could be a scenario where it makes sense to claim a little bit earlier to save on taxes or something like that. It all just depends on what your entire financial picture looks like. You want to coordinate spousal benefits. So especially if you've got one spouse that earned a lot more than another spouse, you want to be really thoughtful about potentially claiming for one spouse earlier or later. There's some different things that you can do there. So you want to coordinate with your spouse. Then obviously consider delaying benefits. If you expect to live past 80, you've got a lot of longevity in your family. That's where you want to think, hey, maybe I should wait until 70 to take Social Security benefits. I'll get the most money out of Social Security if I do that. Use Roth and other strategic withdrawals, right, to minimize taxes. That's really, really important. And then lastly, don't forget those survivor benefits, right? So there are, when you pass away, if you're married, your spouse can get part of your Social Security, just like they could get a spousal benefit. They also get a survivor benefit as part of Social Security. And so delaying can help increase that survivor benefit. So it's not just about the current income that you're going to get from Social Security, but it's also about the income that both you and your spouse are going to get over both of your lives. So really important to think about all of those things as you think about Social Security. So hopefully this was a helpful primer on different claiming strategies, how Social Security works, how we think about it in the context of other planning strategies that we use. Social Security may seem like just a check you get every month, but it's a powerful lever in your retirement strategy. It's really important that you time it right, that there's coordination and tax planning across your entire retirement plan for you to be able to achieve the things that you want to achieve in retirement. So hopefully you found this episode helpful. Share it with a friend or a colleague who's approaching retirement if you did. And if you want help modeling your own Social Security strategy, what you should do, what you shouldn't do, reach out. We're here to help. And until next time, this is Brian C., and this is the Capital Stewards Podcast.